I am, as Tom alluded to, I'm also a shareholder, a negative gearer, a business owner, and I've moved firmly into the angry camp as well. There's a lot of detail in there that Tom alluded to. So the one thing that I think that has really struck me out of that is that professional advice and professional relationships in all dealings now moving forward in such a complicated world is going to be absolutely necessary as we try and sort of navigate, in particular, the next 2 years and then beyond that. So I won't go into too much detail and cover off on what Tom's already covered off on. I'll try and open up some possibilities for investments in what's going to be a difficult landscape moving forward. The disclaimer's there as always, so anything that I talk about today is not personal advice. Please don't take it as such. I have made some projections and the like within the presentation. Obviously those details are not given, they're all guesses at best. Okay, so what I do know is going to happen is that the wealth creation landscape as we know it today is definitely going to change. We're moving from a world where, for whatever reason, policy has created an asset in property that's become extremely desirable, and Australians in particular have an affinity with property that I expect will continue over and beyond the current landscape and take us through into the next 20 years or so, because it is ingrained into who we are as people. So I don't think that the assets necessarily have changed. I don't think that we will necessarily pivot away from what we currently know as a nation and how we currently invest, but I do think that we will start to look at different ways to hold different assets, and then perhaps just take some time and take some stock to evaluate what are actually the best assets to hold for us moving forward. As Tom suggested, I think there'll be some big winners out of the budget. I think certainly accountants. As you can see there in that presentation, it is going to be a really complicated world that we're moving into. So I think accountants and partnering with accountants will be extremely important. I think commercial property, given everything that's been proposed in the budget, I think commercial property will become desirable. I think the principal place of residence and the rise of the trophy home, Tom sort of alluded to this a little bit in his presentation, and I really believe that this will be a vehicle for people to utilise moving forward. I think we'll see more and more trophy homes, as we're calling them, pop up around Australia, with people investing more and more in their principal place of residence with a view to then downsizing at some point and using that capital to do something with. That will come with its issues. I think you'll definitely may have some issues trying to sell that property, and the second tier market or the secondary market of people upgrading their homes will be limited basically to people upgrading. We're taking out a whole stream of people that would always invest into property and go and buy property to negative gear and get the tax deductions and get the future growth. That market's basically been decimated. So we're now relying on people upgrading their homes in order to be able to sell your home. So the demand on that side of the supply chain will definitely fall. I think superannuation out of all of this will be the biggest winner as a vehicle. And my presentation today is largely around superannuation and how I think Australians can use superannuation to invest into now. Despite the long-term timeframe and long-term nature of superannuation, the asset or the tax structure that it provides to all of us as Australians is very important and very generous. So I will be focusing on that, and we'll start here. So this is the current landscape and sort of what's changing. But at the moment, inside superannuation, for all Australians in an accumulation phase, so that's the phase where you are not necessarily drawing down on your assets, you're trying to accumulate wealth, as the name suggests. Within that phase, you can have as much money as you like, basically. Contributions into superannuation are taxed at only 15%. So you can put into superannuation this year, $30,000, have that deducted from your taxable income and pay tax at 15%. So it's concessionally taxed. If you're earning above $250,000, you will attract an extra 15%, but it's still far lower than your marginal tax rate. Within superannuation, investment earnings also only attract an income tax of 15%. So by far the most generous tax rate in Australia at this point in time. Capital gains within superannuation, if you have a large capital gain inside superannuation and you're in the accumulation phase, you only pay tax at 10% on that gain. That's 10%. The issue though, that as most people will realise, that superannuation preserves your capital. You can't touch it. You can't spend it. You can't use it for your personal use until you meet a condition of release. And those rules are retiring after the age of 60, turning 65, or becoming total and permanently disabled. So there are some issues there around accessibility, but if we're thinking about most of the reason why we tend to invest as people, it is because we are trying to generate wealth, and eventually we want to use that wealth for our retirement. Some of us have other goals, and that's fine. But by and large, most of the people that we see are people that are coming in and they have this general plan around trying to generate a retirement plan, be that superannuation or otherwise. So in that sense, it does really lend itself to long-term investing. The risk is that if you need that capital, it's not accessible. So we need to be really careful about what we're putting in and what we're using otherwise. The ultimate carrot here, though, is that when you are retired, and assuming that is the age of 60, you have all of that capital, up to $2.1 million per person from July 1 this year, in an area that is 100% tax-free. So that is $4.2 million as a couple that you can have invested into an area that has no capital gains tax. It has no income tax, and it has no issues as far as accessibility is concerned. You could take $4.2 million out, you could take $2,292 out, you could take $1 out. It doesn't matter. You can have whatever you like. There is literally no rules other than you are required to take out a minimum amount each year. And as a 60-year-old, that's 4%. So you can have $4.2 million investable assets inside superannuation and attract zero tax. Now that, after what we've just seen from Tom, is going to be very, very appealing moving forward, I think. There is a caveat down the bottom here that's coming into play from July 1, 2026, and that's the new Division 296 rules. So that is if you have a higher balance than $3 million inside superannuation per person, you'll attract an extra 15% tax on your earnings. Okay, so in a world where you've got $2.1 million invested in pension phase, tax-free, the next $900,000 attracts a tax rate of 15% on earnings, and over and above that, it's an extra 15%, up until a $10 million balance. Now, if you've got a $10 million balance in super, I figure you've probably got less problems than paying an extra 25% on earnings. Moving forward into 2026-27, indexation has allowed the contribution caps to increase. So now you can contribute $32,500 as a tax deductible contribution. That is your super guarantee contributions, your employee contributions, and any other contributions for which you want to claim a tax deduction for. Those contributions attract a tax rate of 15% and are 100% tax deductible. Over and above that, in after-tax money, so that is cash, you can put in $130,000 per person. Not taxable on the way in because you've already paid tax on that money once before. If you are lucky enough to have realised an asset and you want to maximise your contributions, you can then bring forward 2 years worth of contributions and add to that fund a total of $390,000 using the bring forward rule. That would then rule you ineligible to make that contribution for the next 2 future financial years over and above this one. As I said before, the transfer balance cap, that is the current amount that you can put into a pension phase for any single person. That is $2.1 million per person, $4.2 million as a couple. That is the ultimate goal. That's what we're trying to get to for all our clients. Next year, the employer super guarantee rate is 12%. Okay, so that's the current state of play. I thought I would now start to look at a bit of an analysis around residential property. And I really only picked this asset because it's topical. I think based on the budget, I wanted to see really for myself what it would look like if we compared buying a residential property in our own personal names versus buying a residential property inside superannuation, holding that asset for a long period of time, and what are the tax outcomes. So here we have Homer and Marge, 45-year-old, 2 children in high school, both high income earners on the top marginal bracket of 47%. They're each adding $25,000 per annum to their super. They've got a large amount of equity in their principal place of residence and a self-managed super fund with $800,000 combined. Their objectives when they came to see us, they want to build long-term wealth for their retirement. They want to maximise tax effectiveness in the most efficient structure, and they're looking at buying established property in their local suburb for long-term capital growth. Okay, so that sort of sets the scene. In order to do this analysis, I have to make some assumptions. So I've assumed that this projection starts on the 1st of July 2028, so the new rules are in play. Inflation is within the RBA's bandwidth and sits right on 2.5%. Wages grow at 3.1%. The property purchase price is $2 million. Homer and Marge pay a deposit of $400,000 and they pay stamp duty, so they need to borrow $1.6 million. The rent on that property is rented at 4%, so that's $75,000. It grows at 4% per annum, okay, and the capital growth is 4.75%. Okay, the expenses are $15,000 per annum. The superannuation is $800,000 combined, so we need to take out $500,525 to facilitate the purchase. The remainder of that fund is invested in high growth investments, which provide 3.75% worth of income and 4% worth of capital growth per annum. And as I said before, the clients are adding $50,000 to this fund per year. So we considered two structures. The first is the traditional method, so that is to go and get a loan against their principal place of residence at a rate of 6.25%, on which they will pay $100,000 worth of interest per year. The second is to borrow the money through a self-managed super fund via what we call a limited recourse borrowing arrangement, and I won't sort of delve too deep into that, but if you do want to discuss it, come and see me or one of the other advisors in the room later. And the interest rate on that is $108,000. So whenever you borrow money through a self-managed super fund, it's considered more risky to the bank and you will attract a higher rate of interest. These interest rates I did not make up, they were provided to us by a mortgage broking team. Okay, so what we're looking at here is the cash flow in the first year under the new rules. So as you can see here on the left-hand side under the personal ownership, rent is $75,000, the costs are $115,000 including interest. So we've got a net negative cash flow of $40,000. That is now non-deductible. We don't get any tax refunds for it. However, what happens is the losses accumulate and are quarantined to offset future gains or income. Okay, does that make sense? So it's not a one-year proposition. Those losses accumulate over time. So however long you hold that property for, and you have no positive gains, you continue to accumulate those losses and they can then be used to offset future capital gains. So the after-tax position on that investment is negative $40,000 in year one. Compare that to the self-managed super fund, okay, where we have $75,000 worth of rent. Into the fund, we also have contributions of $50,000, so that gives the fund investment income of $11,230. Okay, investment income of $11,230, which gives the fund total income of $136,230. So when the fund does its return at the end of the year, it nominates all those amounts as its income and then needs to pay tax on that. It has costs of $123,000, so net income now is $13,230. And the fund will pay tax on that income at 15%. So in this particular instance, we are able to use the negative loss on the property, the net negative position of the property, to offset the income of the fund, which then reduces the tax of the fund and means that the super fund only pays $1,985 worth of tax for the year. And that provides us with a tax saving within the fund in the first year of $7,200. Okay? So compared to not having the property, we save $7,200. So the property doesn't improve cash flow in this instance, but it does eliminate tax inside the system. And the key for the other side is there's no tax advantage, but it does provide a tax advantage later in life when eventually you sell that property and the losses have been accumulated all the way along. In this particular instance, using a 2.5% inflation rate, it's the positive gearing on that fund doesn't occur until year 14, with a 3% interest rate or slightly earlier. And for the self-managed super fund, because of the higher interest rate, it takes 15 years for that fund to become positively geared. So the reason I put that up there is because if you only have that property, that is the amount of time you'll need to accumulate. You'll be accumulating those losses all the way along personally until year 14. At which point then you can use those accumulated losses to start offsetting the positively geared income or the capital gain, whichever occurs first. So fast forwarding then 15 years, this is what it looks like. That property is now grown to be valued at $4.012 million in future value dollars. In present value, if we discount that by 2.5% inflation, in real terms, its value is $2.77 million. The loan balance, because it was interest only, remains at $1.6 million. The quarantine loss pool is what I'm calling it here. So that is the amount of accumulated losses within the personal acquired property is 298,585. So that is the total losses accumulated over that duration of 15 years, which it was previously negative geared. Now we can't claim that, so we accumulate that. That totals 298,585. Within the self-managed super fund, the accrued benefit that we had by saving on tax over that entire duration is 88,945. Okay, so all in all, we have a pre-tax equity on both positions, ignoring the tax consequences, of 2.412 million. So at this point, they're exactly the same. The property is exactly the same. We've not realised anything. We've got some accumulated benefits on either side, but by and large, they're exactly the same. We've got $2.412 million worth of equity. So we look at the sale price here, and then we take out the selling costs and repay the loan. We end up with $2.328 million left over. Okay, and in today's dollars, that's $1.6 million. Now that occurs either way. Whether you have that inside of super, outside of super, those numbers are exactly the same. What does change is the tax outcome. So on the left-hand side here, I have the personal structure. So what we have here is the realised gain after indexation. So it's indexed at 2.5%. And remembering now what happens is that the gain is what you sell the property for minus the indexation. So it's 2.5% over 15 years. So the real gain after indexation is $886,000. Take off the total carried forward losses that we've accumulated over that entire duration, gives us a taxable gain. Tax on that at 47%. Net equity after tax, less the initial investment, gives us a net profit of $1,551,000. Okay, so $916,000 in today's dollars. So the total tax avoided or saved, depends how you like to frame it, in that instance is $140,335. So that's the benefit of those carried forward losses in after-tax dollars. If we now compare that to a self-managed super fund, the numbers are exactly the same. We've got the capital gain now, but we're only paying 10% capital gains tax on it. Okay, 182,000 gives us net equity there of 2.145 million. Less the initial investment gives us a net profit of 1,645,245. We add back to that to be able to compare apples and apples. We need to add back then the accumulated savings that we had along the duration. Gives us a net strategy profit of 1,734,190, or in present value dollars, $981,055. So you can see there quite clearly that strategy, purely by having that investment invested in the right structure from the get-go, allows Homer and Marge to take a much better and bigger gain. Now the gains are quite substantial either way, so you wouldn't be too disappointed, but having that structure right allows them to get that gain up to $1,056,000 holding it within the self-managed super fund versus $916,000 holding it out. Now, if Homer and Marge were able to speak to someone to get some advice and they held off on selling that property until they were in retirement phase, so that is they're over the age of 60 and have retired, that changes the ball game again. So in this particular instance, because they're retired, there is no tax to pay on the sale of that asset whatsoever. That is 100% tax-free. There's no capital gains tax, no income tax. So simply the equation becomes, what did you sell it for? Take off what it costs you, and that will give you your net profit. Add back in the total savings along the way, and your net strategy profit now becomes 1.183749, which is $260,000 in today's dollars better off than buying it personally. And this is why I think that investing inside superannuation for long-term investors now, this is a 45-year-old person, is going to become key. I think that we will see people start to target superannuation with a view that they're trying to accumulate $2.1 million per person. It would be the ultimate goal, so up to $4.2 million, ignoring largely what the asset is, because that could apply to shares, it could apply to all sorts of things. But the overall benefit there of being able to have an asset that you can sell 100% capital gains tax-free and then have no issues as far as access is concerned, is going to be too good of a carrot to ignore, I think. So this is where I think Australia is going to be moving to. There will be investments outside super, in particular for those that wish to retire early, so for those that wish to have access to a portion of capital that they need before 60. There will be other investments, and I think investment bonds and Other tax-friendly investments will really come to the fore. But for anyone that's looking to retire after the age of 60 and want a definitive plan and are happy to commit to a long-term strategy, I just can't see that there's going to be anything that's going to be able to compete from a tax point of view, considering that both the investments are exactly the same with what superannuation can provide. So the key takeaways from that are that assets will remain the same. I think Australians will continue to invest in property. I have no doubt about that. I think that long-term gains inside property, particularly the ones that we've seen over the last 10 years and also particularly here in Brisbane, I think those days could be numbered and we could revert back to sort of the returns that we were used to through the 90s and early 2000s, but that remains to be seen. Supply and demand will have a big impact on that, but I certainly think that when you strip out 40% of the demand, you're certainly going to see some sort of impact, and that could be short-term, could be long-term. I still think that people will continue to invest into property. I don't think that's going to stop. It's just how and where they do it. I think that superannuation will become and is going to become very, very attractive from now on. It is an environment that has largely been left alone in this year's budget, and that's been 2 or 3 budgets in a row, which is nice to see. And whilst the government puts their focus on other areas, we will start to see people pivot to this. So in closing, property still works. The asset still works provided you get a positive return. So that will work no matter what the case is. But I think in a post-budget world, structure is key. It's important to go and analyse the structure, determine what the overall outcome is that you're trying to achieve. What is your investment time horizon? When are you likely to sell? What are you actually trying to get out of the investment, not just the investment itself? And then make sure that when you have all that knowledge to hand, you choose the appropriate structure, you get the appropriate people in place, you get the appropriate advice, get it all set up, ready to go, and then commit to buying the asset. And I think doing it any other way is probably going to lead to negative outcomes. That's it for me today. I'm happy to take any questions, and I think Tom will be back up also.